Hi all, good afternoon. So this is the second session on EVP, Entrepreneurial Venture Planning. Uh, yeah, so we had one session last Sunday wherein we went through the basics of the course. We understood that this course is a capstone course wherein you will be using all the concepts that you have learned till now. Basically, all the finance and accounting concepts, the marketing 101, and product management concepts. So whatever you've learned till now, you'd be applying to this course. And we also saw that the students would have to be grouped together in different groups, and each group will have to finalize on an idea. I guess Ashish has shared a Excel sheet where you can nominate yourself under different groups. So I would encourage you guys to start nominating ASAP. We should have finalized these groups mid of last week itself. So at least finalize the groups by end of day today. So that is the first task to be completed from your side. Once you finalize the groups, you need to finalize on the idea. What idea would you be pursuing for this course, wherein you will be talking about the idea, you will refine the idea, and you will give a shape to the idea by coming up with a business plan, and you would be pitching this plan to a group of investors and target to get invested by VCs. So in the first session, we had an overview on this course, on how this course will be structured, and what all things have to be covered as part of this course. And since it's a capstone course, there will be more activities from the students' side, wherein you will have to come up with the idea, and you'll have to build the business plan. So in today's session, we will get to know in detail about different kinds of investors. So what exactly you mean by venture capitalist, angels, private equity. So we will understand the complete ecosystem of investments. What are the different kinds of investments that an entrepreneur can pursue, and what all are the investment at different stages of the idea and the enterprise. And primarily, we'll have to talk about what is VC investable plan. Not all plans are eligible to be funded by venture capitalists. So there are certain kinds of businesses where VCs are interested in putting their money. So we need to understand what are those businesses, and we need to also use that insights in refining our idea, or maybe changing our idea, so that we would be starting a business where VCs would be investing their money. And then the third thing, that is the key attributes of a business plan. What are the three main ingredients or three main things that VCs or any investor look for in a business plan? So since the teams and business ideas have not been yet finalized, we won't be including that here. Uh, Hopefully you guys will be able to finalize the teams and idea by end of day today. Because in the next 2 days you will have to come up with the elevator pitch video, wherein each one of you as an individual will have to shoot a video about yourself, a short 2-minute video, and you'll have to record your elevator pitch. I'll be discussing about this video by the end of this session. So without wasting time, let's go ahead with this session. Yeah. So what is a VC, or who is a VC, venture capitalist? And what is a complete ecosystem? Who all are the different people who are part of this ecosystem? Yeah. So VCs are venture capitalist or venture capital firm. It's part of a bigger ecosystem called private equity. Now, to understand who VCs are or what are venture capitalists, you need to take a step back and understand the investors ecosystem, who all uh, are eligible to be called as investors. Now, investors are typically wealthy entities or individuals. It can be individuals or it can also be entities like a company, a pension fund, university endowments, ultra high net worth individuals, HNIs or UHNIs, sovereign funds. So these are the different kinds of wealthy entities. So basically, when you say pension funds, these are people who manage uh, the uh, the money invested by individuals for pension. So what they do is that the individuals, the working class, invest their money with this pension fund, and when people retire, the pension fund gives back monthly pension to these people. So it's kind of mutual funds. Then you have, as I was saying, the university endowments. The university will, the different kinds of universities, the private universities and public funded universities will be having their own funds. They'll be having their money, which they park in different entities. Or one major source of funds these days is the sovereign funds. That is, the governments that we see will be having their funds. So they'll be having their investments in funds, and these funds will be deployed outside their country, typically outside their country, because within their country they already have investments, and now they want to de-risk by investing outside. One example would be the sovereign fund of Singapore, which is called GSIC, Government of Singapore Investment Corporation, and Temasek. These are the two sovereign funds of Singapore government. So since Singapore is a developed nation, they have a lot of money and they don't see much growth within their country. So what they do is that they have created their sovereign fund, and this fund invests money in emerging markets like India, China, Africa, etc. And another sovereign fund is the Qatar sovereign fund. Qatar is an oil-rich nation. They have a lot of money. Again, the same scenario. They don't have much growth these days. So they have created a fund which will invest money in other emerging markets and other developed economies. So essentially, you have a lot of rich people. You have a lot of rich institutions. You have got a lot of money. They want to invest in ventures or in other institutions where they see growth. So that's an ecosystem in a simple words. Now all investors are not equal. There are different kinds of investors in this ecosystem. Starting from, at one end you have people who are playing very safe. They play very safe and they don't want to lose their money. At the same time, they are not expecting huge returns on their investments. So they want safety of their capital and they don't want to lose money. At the same time, they don't want to make big profits. They're happy with very small profits. The point over there is that they don't want to risk it. So the moment they want to take back the money, they have that option. So they are the very safe or low return assets. And typically what you have over here are the government bonds and debt funds. So these government bonds are, every country issues bonds. So the country says that we will pay back this money after a period of say 7 years or 10 or 15 years. So since it's backed by government, what it means is that these bonds are very secure. As long as these governments are there, the money will be paid back. So more than a company, a government is more has got more legitimacy. They cannot just close down, right? So if you look at the U.S. government, it's the most secure government bonds, and at the same time, it's the least returns. So the returns are like some 2 or 3% per annum. That's very small returns, but you have protection of your capital. As long as U.S. government is working, you are sure that you'll get back your money. So there is no problem with there's no risk. It's zero risk investment. And then you have the safe or moderate return assets. These are this is not as safe as government bonds, but still it has got capital protection. And at the same time, the returns are better than the government bonds. So it will be typical like you'll be getting around you say 8 to 12% yearly returns. That's the bandwidth. 8 to 12% you'll be getting yearly returns, and the risk will be much lesser than directly investing in companies or running your own business. But it's not as safe as a government bond. There is no government backing to it. It's just that you are investing on things which is more reputed. So that would be like investing in real estate, investing in listed stocks. When you say listed stocks, these are stock units of those companies which are public listed, because there are a lot of compliance and rules to be followed when you are doing a public listing. So public listing is like when you have a company which is listed in Bombay Stock Exchange or New York Stock Exchange, London Stock Exchange. In these big stock exchanges, if you list a company, there are a lot of regulations and compliances to be followed. What it means is that you cannot list any kind of company, and you cannot just shut down such kind of companies. It's not possible. So you have to have a proper quarterly financial performance review, where you have to come out every quarter saying that these are the parameters of the company, these are the way in which the company's performance is measured, and this is where the company is doing very good, these are the things that is requiring improvements. All this information is out in the public. They have very strict accounting practices which are followed. So it might not be as safe as a government bond, but it's not like investing in a startup. It's a well-established company. They've got all the processes in place to make sure that they don't fail. So investing in these kind of companies, that's called safe investment and moderate return. So where you'll get around 8 to 12% returns. And mutual funds again fall into this category. So it can be real estate, listed stocks. Listed stocks, you can directly invest in stocks through stock exchange, or you might invest through mutual funds. You'll be buying fund units, and these fund managers behind the fund unit, fund house, would invest again in the stocks. So this is the way it works. Now the third group of investors, which is like high risk, high return assets. These are the private equity investors. Now, who are these people and what do they do? They invest in high risk assets. When we say high risk assets, these might be companies which are not yet listed due to various reasons. One of the prominent reasons might be that those companies might not be as huge as those listed companies. They might not be following all the accounting practices because they have just started, or they are in a niche market. There are various reasons for that. And if you are not publicly listed, it gives you a lot of freedom, because you won't be dealing with the public investors. You'll be dealing with the private investors. So, behind closed doors, you'll be talking to investors and signing them up. You will be reporting the company's health directly to these investors. You're not giving these information to public. So your financial parameters, your balance sheet, your P&L details, none of them would be available in the public domain. So if you look at Flipkart, it's one of the biggest private limited company in India. It need not report its revenue. It need not report what is the profit it makes. Whenever you hear about the Flipkart making losses, all those stuff, it's actually information leaked out of certain analysts. It's not information which is published in public domain, like what Infosys or Wipro does. All the data of Infosys and Wipro is out in the public domain because it is listed in BSE and it has to be made public. Whereas a company like Flipkart, it is not a listed company. It is a private company wherein they have private investors, and Flipkart is responsible to talk about their financial parameters only to those investors, only to those private investors. So that's how private equity works. So this is the different types of investors. So ranging from very safe, very low return investors like investment opportunities like government bonds and debt funds. On the other hand, you have private equity, where there is no government intervention, there is no security of your money. Because in private equity, what happens is that if the company closes down and or the promoters get absconding, there is nothing there's nothing much that the private equity can do. Yes, obviously they can take legal options, but those are limited. It doesn't come with the government protection, which you get in the first two options. That is the government-backed bonds, debt funds, or in you say investing in listed stocks. So third option is more riskier, but at the same time, if you look at the returns, it's huge. The returns that you get will be very huge. We'll get into the details in the next coming slides. So when we talk about private equity, there are different kinds of there are different kinds of people. On one end, again, you have the typical PE funds, the private equity funds, and on the other end, you have angel investors, and in between, you have this VC, venture capitalist. So these are three kinds of investors within private equity. And VCs are the person that we go for funding. When you have an idea, you put some money together from your friends, family, or from angel investors, and you start upon that idea, you get some traction, then you reach out to VC. When you talk to VC, it will be typical that like you have an idea, and with this idea you have started something and you're getting some small traction and you want to scale up. That's when you go to a VC. Once you scale up, once you have enough, once the company is running, then you go for private equity. Okay, so before we get into detail, we'll just understand how VCs work, because it's very essential that you know how VCs work before you go and pitch before the VC. Now, typically a VC fund, how it works is that a group of managers, we also call them general partners, they typically come from the investment bankers background. Typically that's how it happens. Or one of them might be having some experience running companies. So some group of people get together, they put in their money, and then they reach out to those people are called general partners. Okay, general partner are those people who put money and who have the control over the VC fund. Okay, and then they reach out to the limited partners. Essentially, these are people who have money and who want to invest or be part of a VC fund. So they reach out to these limited partners through their personal network or their professional network prior to starting the company, starting this VC fund. They reach out to these people, convince about the idea and put in the money. So the limited partners put money, the general partners also put money. And then the general partner says that we have started this fund today, and now from today to 10 years or 12 years, this fund will run. And what do? In the first 2 or 3 years, they will scout for companies. They will look out for early stage companies which are promising, which they believe would give 100x or 200x, 100 times or 200 times returns. Okay, they look for all these companies. In the period of first 2 to 3 years, they'll make sure that whatever money they've collected initially is disbursed or is invested in different companies. That's what you see the portfolio companies over here. They'll be having a number of companies. And there are different kinds of VCs. There are VCs who are open to any kind of investments. There are certain VC funds which are specialized on geography, on market, or on sectors, saying IoT specific, or broadly technology specific, or e-commerce specific, health specific, fintech, that is financial technologies, etc. So there are different kinds of VC funds like that. Now they will invest in these portfolio companies for a period of 2 to 3 years, and then wait for the next 6 to 8 years to do the exit. So that's a typical pattern. So in a total of 10 to 12 years, they will invest this money somewhere, get the returns, and give back the money to the limited partners and pay themselves up. And internally, they'll be having VC management fees. They'll be having employees. Their employees are typically called associates. They'll be having some MBA guys recruited who will be again having some junior experience in investment banking and all by dealing with customers and investments. So people who are having 3 to 7 years experience typically, they are the associates. So they have these associates, they pay salary to the associates. These associates go to the field, understand different kinds of startup, talk to them, fix appointment, and then these general partners and associates interview these startups, and then finalize on the investments and invest the money in the companies. That's a typical flow. So the point over here is that when you start pitching to investors, what would happen is that you might be initially talking to the associates, the people who are employees of the VC fund. You'll have to convince these associates, plus you will be having meetings, you'll be having pitch sessions with the general partners who will be the real decision makers. Those will be more senior people, and you'll have to convince them also about the idea. So the EVP course is all about pitching to the associates and to the general partners, the decision makers or the general partners. So when you pitch to them, how do you prepare a plan? What should be your thought process? What are the ingredients of a business plan? What are the questions that you can expect from them? And what are things that they look when they evaluate an idea? So these are things that we will understand in this session. So these are some of the nomenclatures, naming conventions that you need to understand when you're dealing with these people. So a typical business, you can set it up like this. Initially it will be an idea, it will be just in your mind, and in your friend's mind. Typically a single individual or a group of 2 or 3 people, you'll be having an idea, that's all. You don't know how to start, you don't know where or what to do, you just have an idea. And at that phase, who invests in you? So it's written F and F and F. So it's family and friends, and the F inside the braces stands for fools. So basically, no sane person would invest money on just an idea, right? So that's the reason we say family, friends, and fools. So essentially, these investments will be very small investments, and in Indian context, it will be something like 5 to 10 lakhs. That's what you can expect, not more than 10 lakhs. So it is just based on your idea, and your family, your friends will invest, and anyone who is foolish enough to believe in you. That's it. It's just an idea. You don't have anything else. What you'll be having is just, you'll be talking about the idea. At max, you might be having a PPT. That's it. Now, the next phase is that you might have using that, and it might be your own money. In most of the scenarios, I've seen that people start with their own money. If you have an experience of 5 or 10 years in the industry, obviously you'll be having 4 to 6 lakhs to spare. So 2 or 3 people will get together, pull in some money, and start on their own. So that's how typically it happens. You don't go for outside investment, or you don't ask money from outside unless you yourself put some amount of money and start by yourself, right? Now, once you have that, what happens is that you typically register a company, and then it might not be any fancy office. You might be working from your own home. You'll be having a laptop. You would have bought some basic software, and you'll be putting things together. If it's a technology-based thing, you would be reaching out to some freelancers. You'll be doing some coding by yourself if you're an engineer, or you'll be asking some of your friends to pitch in and do some help for you. So that will be the phase, and then you might be pitching for your first few customers. You start getting money from the customers. So that is the initial phase. At this phase, still you are not convinced, or you are not able to convince others that you will be able to go forward. You will be able to exist. These are the first 18 months of your venture. The first 18 months of your venture is very critical, in the sense that if you cross these 18 months, then it means that you can exist. You might not be successful, but you are disproving the existential threat. Okay, what it means is that you can live. Your company will live for some more time. If it doesn't cross the 18 months mark, what it means is that it won't be like a company, or it will be more like a self-employed stuff. You'll not be able to recruit people. You'll not be able to pay people their salary on time. So that's what it means. So once reach that stage, it's at that, or just before you reach that stage, it's at that time that you start talking to the incubators or your angel investors. So incubators are institutions. People run incubators where they might not be giving you big investment. They will be hand holding you. They'll be giving you a lot of inputs. Incubators give you a lot of early adopter customers, and they might also help in getting some vendors free of cost doing certain things for you. Say for example, most of the incubators give Amazon or IBM software cloud services for free, wherein you can host your software for free for a period of say 1 year or 2 years, which is a big thing. You don't have to pay money for hosting your software. So all those things, all the supports are there, and then the angel investors also come in at this point of time. People might put around 10 or 20 lakhs on your idea. They might take some, again, 5 to 10% stake in your company. So these are the investors which will come at that point. And then you have the VC fund. Now the VC fund comes in once you have a validated business plan. What do you mean by a validated business plan? It means that you are sure which kind of customers you are approaching. You're sure of what problem you are solving and the solution that you have, and you've already already sold that to a limited number of customers. So for example, if you're talking about a SaaS-based software, a simple tool, so at this stage you would have built that tool through different iterations. You would have ran this software with multiple early adopters, and you would even have some people paying for this software monthly. So that is the point. So now once you reach that, what you have to do now is scale up. So you might have reached 100 customers. Now since you have reached 100 customers, you are confident about your product, you are confident about customer acquisition, your methodology of customer acquisition, you are confident about your plan, you're confident about a lot of things. But the only thing now is that you don't have enough capital to scale. You don't have enough capital to go from 1x to 1000x. You have got 100 customers now. How do you go from 100 customers to say 100,000 customers? You need to scale, right? You need to scale up. So for that you need funds. That's when you go to VCs, venture capitalists, wherein you have all the solid data with you. You're not at a big company wherein you can go to the stock market. No, you're not reached there. But at the same time, you're not just a startup who is talking about an idea. You have a solid business plan. You are executing certain things and you're getting money from the customer. It's just that you need to scale up. And to scale up, you need more resources. And for that, you are reaching up to the venture capitalist. So these are the typical VC funding that happens in India. You have seed funding. The seed funding is what we are saying, the initial phases. That is from your self-funded friends, family, incubators, or angel investors, early stage funds. In all these things, what happens is a seed fund. It can be anywhere between 10 lakh to say 3 crore. It's a seed fund. Now then we have the technical terms called Series A, Series B fund, Series C, D, like that. Now what it essentially means is that the different levels of maturity that your company has achieved, and at these levels what is the valuation that you can ask for, and what is the investment that you can ask for. So Series A typically it's like $1 to $3 million. Series B funding would be $5 to $15 million, and Series C and up would be more than $20 million. These are not hard and fast figures. These are just indicative figures just to give you a direction. Now, okay, yeah. So now one big question, or one typical question which comes up: why do you need VC funding? Is it really required? Is it really required that whenever you start a company, you need a venture capitalist fund? Do you need it or not? Yeah, so this is the correct slide. This is the point I was saying. So why do you need VC funding? Do you really want it? Say, if you're a person who has this idea and you want to execute, plus you have enough money. Let's just take a hypothetical example that you got 100 crores in your bank account. You are a rich guy. We are taking one extreme case. Okay, you're a rich guy. Do you need VC funding? Uh, the point is, when you start a company, there's a huge risk. It's a huge risk. It's like there's statistics which says that for every 1,000 companies started worldwide, only one survives. It's like something around 99.9% you have the failure rate, and success rate is only 0.1%. Let's be realistic. That's the statistics. So 999 of the 1,000 companies do not make it. They're not successful. So when you start a company, when you put say 10 crores, there is a 99.9 chance that it might fail. Now how do you overcome that? Now you can't chicken out, right? What do you think about entrepreneurs? Are they people who are scared about taking risk? They are not scared about taking risk. Entrepreneurs are people who take big risk and who reap in bigger rewards. Those are the kind of people entrepreneurs are. So what is the trait of a successful entrepreneur? The entrepreneur love the risk. They love the returns. You know, it's a human nature. They love the returns, but they hate the risk. They don't want to take too much of risk. So how do you reduce the risk, or how do you distribute it? What do you do with risk? That's a correct question. What do you do with the risk? So what you have to do is that you need to distribute the risk and rewards. It's not just the risk that you can distribute. No one will take the risk alone. You need to distribute your risk and you need to distribute your rewards. So then what happens is that you have a company, you have 100% stake, you own that company. Now if this company becomes successful, again you own 100% rewards. If this company becomes a failure, again it's up to you. So how do you distribute that? So you take 20% out of the company and give it to someone else for some money. So what happens essentially is that you're distributing out your risk and your rewards. Thereby what you essentially do is that you get more energy to focus. You get other people also to come into your idea. You get other resources also to come into it. And what it essentially does is that it gives a lot of support to you as an entrepreneur to carry on with your journey. That is very important. That's the first important thing with VC. Second thing is that the VCs typically go for non-boutique business. What do you mean by boutique businesses? These are businesses. Boutique businesses are those which are very specialized. Which are very specialized and very personalized. That's a boutique business. So when you do something, you're doing when you're running that business for certain kind of people. Say when you're talking about homemade chocolates. Homemade chocolates is a boutique business. You get homemade chocolates or homemade cakes. It's a boutique business. You or your spouse is very passionate about making chocolates or cakes, and you have some two helpers. What do? You get calls. You have advertised your homemade chocolates and cakes in your neighborhood through WhatsApp, or you put some posters and you're advertising through Facebook, again within your neighborhood, wherein you have some 10-20,000 people, some apartments. Now some of these people know that you make good chocolate and cake. They order whenever they want, and whenever you get the order, you make it and deliver it. That's it. You make some amount of money, but you won't scale, right? It's a boutique business. You're doing it for a small group of people within your neighborhood. That's boutique. No, that's not scalable business, and that is not easy investable. The point over there is that the risk and effort that you put and the rewards that you get, if you take it as a ratio, that ratio is much higher for a non-boutique scalable business. What do you mean by scalable business? Something like Google and Facebook. It's highly scalable. Google can reach out to any corner of this world. It's not centered to any geography. All the Google provided apps, anyone can use it. You have an internet connection, you can use Google. And once you use Google, you become part of that business Google, and as Google gets more users, they get more advertising revenue, they make more money. That's how Google works or Facebook works, all these companies. Or another example that we can take is McDonald's or KFC's, all these food chains. They're highly scalable business because they know they have a fixed menu. They know how to source the material, how to source the uh, uh, raw material for food, how to train people. They have a process. Everything is set. It is set in such a way that they want to start one new store. They can just do it in, say, with 1 or 2 days planning and some funding, they can do it. It's very easy for them. It's a cookie cutter approach that they have. So those are scalable businesses. So VCs are typically looking for scalable businesses. They won't invest in boutique business. And what is the point here? The point here is that the effort that you put and the risk that you take versus the rewards that you get, that ratio is much higher for a scalable VC investable business. So it makes more sense to start a scalable business, a VC investable business. After that, one final thing is a VC invested venture has got more credibility. It has got more credibility than just a venture that you have started by your own money. That's a fact of life that you need to understand. When one person believes in something, there is a limited number of people who would believe in the same. But when 100 people believe in something, you can get more people to believe on that. So what it essentially means is that when you run a company, you will have a ecosystem of customers, employees, vendors, investors, etc. Now, if your venture is VC invested, it gives more credibility so that you can get more customers, you can convince your current employees, and you can get more better employees, and you can connect with a bigger set of vendors. So it opens up a bigger set of opportunities for you. So it is actually a big factor of credibility. Okay, so these are three important things why you should go for VC invested business, or why you should go and pitch your business idea to a VC. Why you should sell a part of your company to VC. These are three important points. That is, distribute your risk and rewards, which will help you to focus, channel and focus more resources to your idea. Second, non-boutique or scalable business makes more sense with respect to the risk and rewards ratio. And finally, it gives you more credibility. So this is what I had covered in the earlier point also. Like, they have a typical 8 to 10 horizon and all. And okay, one important point over here is about the returns. We were saying that 100 times returns. VCs look for 100x returns. They put 1 crore in a company. In 10 years, they want to make it 100 crore. That's their aim. They're not looking for a 10%, 20%, 30%. That's not their range. They look for 100 times return. Now, would they make this return with all their investments? Do you guys think would VCs be able to make such kind of 100x returns with each and every company they invest? Yeah, no, they won't be able to. So typically, if they invest, these are not hard and fast numbers. Again, these are based on historical data. So if they make 15 investments for a fund, typically 8 to 10 die without giving any returns. They just die out. They won't be able to generate any returns. Then when you say they won't be able to generate any returns, what it means is they will just shut down. You've heard about all these shutdowns recently that has happened. A lot of companies will shut down and laid off employees, all those things. Those belong to all these 8 to 10. So we expect to, out of the 15, they expect almost half to die out. Not everything will work out, right? Whatever checks and balances you put, whatever criteria that you give for investment, there is a chance of luck and how the markets evolve. So there are a lot of things which are out of control, which you cannot foresee. So because of those reasons, half of them would die out. Now there will be 4 to 5 which will return modestly. These are companies which will have some customers. They will struggle for some time period, and then they'll find out some way to get acquired by a bigger company. That's what typically happens. They get acquired by a bigger company, or they might go on for a long time, generating 10 or 20% yearly growth. They just go on like that, and they won't be a great company, but they'll always be able to hold on because that market space would not be encroached by other players. So it will go on like that. So those are the 4 to 5 which will return modestly. Like they might triple or give 4 or 5 times return. You invest 1 crore, and after 10 years you might be getting some 5, 6 or 10 crores, etc. Then there are 1 or 2 companies which will actually give you the 100-time investment. One typical example is WhatsApp. I think they investor Sequoia Capital Sequoia is a big VC fund based out of US. Where Sequoia had invested around 20 million US dollars in WhatsApp, and it was sold for a whooping 19 billion US dollars. So I think they made more than 100 or 200 times whatever they invested. So such things happen very rarely. Okay, so now we have the 3 key attributes of a good VC fundable idea. So I was saying, right, when you go to a VC and pitch in front of him your business plan, you're not just talking about an idea. You're talking about a solid business plan. You're talking about something which can be achieved. You're talking about something big but which can be achieved. You're showing him the exact plan, how you're going to do this big thing. Okay, so what are 3 important attributes or ingredients to this plan that you're going to submit to the VC? Those are 3 things that will be seeing. It's going to be a little, I won't say complex, but it's going to be a little heavy. So just brace up for these 3 important, attributes. It requires some reading from your side also. After this session, I would strongly encourage you to browse in internet for these 3 concepts, and then apply these 3 concepts to your idea. That's when you will get a lot of questions. Then we can have multiple discussions, but let's make sure that you guys put enough effort on these 3 concepts. So at this point, let's take a small break of 5 minutes. We'll come back at 3:05. Okay, and then we will take up these 3 topics one after the other and go into it deeper. Especially market size and unit economics, it's going to be big topics. Let's go into it. We'll meet at 3:05. Okay, so welcome back, guys. Okay, so we are talking about these 3 attributes. That is market size, unit economics, and go-to-market. So these are 3 things that we have to start off now. So what is market size or market sizing activity? What is essentially, what do you mean by market sizing? So basically, when you come up with a new idea or a product, you will be selling this to a group of customers. You won't be selling this to one customer, you will be selling this to a group of customers. Now those customers belong to a superset called a market. So a good example would be, if you're talking about Gillette razors, the shaving razors men use. So if you talk about the market for Gillette razors, it will simply be all those men in that geography that you selected who would be using razors. That's it. All those men who use it. That is a market. And when you say market, it has to be a money figure. Okay, you cannot just say that you have say 30 crore men in India who would use razors. That's not enough. We will have to say things like these 30 crore people, how many razors would they be using a year? So essentially, how much money would they be spending? So if you put 100 rupee for a razor, let's stick, and one person would use 1 stick for a year. it will be like 30 crore into 100. So you can say the market size is 3000 crore for Gillette Racer. So when you say market size, what is it? It is basically it is not the revenue that you can get. It's not the revenue or the projection of revenue that you intend to achieve. What you're essentially saying is that what is the size of the market where you are trying to position this product. It doesn't mean that you will be getting the 100% market share. What it means is that when you when you sell something and get some money, what is the total market size of that? So your company is making 100 crore out of this particular product, but you can talk about growth only if you know what is the complete market size, what is the full market size. Then you can say that we have a market size of 10,000 crore and we are generating 100 crore, which means that we are having only 1%. So which means that you can grow. There is huge space for growth. You can also see that there are some other few players, which means that there's a huge space for new players to come and new products to be launched. So that's how you understand the situation. So what do you mean by market size? It is simply the size of the market where you intend to launch your product or company. Now, how do you assess the market size? How do you do that? It's not straightforward. In the case of Gillette, it was pretty straightforward. Let's go through that exercise once more of understanding how you do it. So in case of Gillette, it's like Gillette is selling razors, men's shaving razors. So if Gillette is coming into India and they need to evaluate the market size, simply put, they can just take the number of men above the age of 18. Assuming above the age of 18, people would be shaving. So you have around say 50 crore people above the age of 18 in India, and out of that they will say that okay, 60% of this set of people would regularly shave. So it will come down to say 30 crore people. And as I said, one razor stick would cost 100 rupees, and you will put an assumption saying that one person would use one razor for a year. So a person would spend 100 rupees to buy a razor and it will last for a year. So you come up with a market sizing of 30 into say 100 rupees, 30 crore into 100 rupees. It will be 3000 crore. So Gillette understands that the current market size is for 3000 crore. So when Gillette says that okay, in the first year we will be selling this many razors, they would know that out of this 3000 crore, what is the market share that they are achieving. And based on that, they can say in the subsequent quarters or the subsequent years, how much are they targeting to grow. So this will give a picture to an investor as to how big the opportunity is. That's the whole point. The market sizing activity would tell the investor how big the opportunity is. And it will also tell the entrepreneur, or it will also force the entrepreneur to build a plan in such a way that the opportunity can be achieved in a systematic and practical way. So you have an opportunity of 3000 crore rupees. Can you achieve that in 3 months? No, it's not possible. So when you have a market of 3000 crore rupee, you can come up with a plan, which says that okay, in the first quarter you will be achieving 1% of that. You'll be getting 30 crores. And how you will achieve this 30 crore. And then in the subsequent quarters, you can put a plan on how you will be growing further, how fast your growth will be, and different phases, how the growth will change, how you will come up with new resources. So all these things start taking a shape when you have a market size. When you define a market size, then that is the starting of this. So how should we calculate it? That is the most important thing that we will see in the subsequent slides, how exactly we will be calculating the market size. So we understood what market size is and why should we calculate it, and now we will be going into the detail of what are the techniques of calculating market size. So this is one example that I was talking about Gillette razor. Here we have a different example. Potential buyers of your product or service. So for example, you're taking the case of mobile phones. So you're telling that the average price for a mobile phone is $100. And then you're also coming up with a number of people in India who can afford it, say 50% of the population. So you have a population of, you have a population of 1.2 billion, 120 crore people. And after that you make a rough estimate, say that 60 crore of the people will buy this. We are not saying 60 crore of the people will buy this mobile phone. What we are saying is 60 crore of the people intends to buy a phone worth $100. That's a statement we made. So based on that, we tell that the Indian mobile phone market is around 60 billion US dollars, and this is yearly. This comes the market size is for a year. Now, when you come up with such a number, then it will be easier for you to carve out your plan of launching a new mobile phone in the market. Now, when you talk about launching a new mobile phone, you can talk about segmentation. You can come up with ideas like what is the cost of your phone, in which segment of the population you want to position this phone. Now, for that segment, how much would be the market size, and in that market size, what is the share that you are intending to achieve in the initial months, initial quarters, etc. Those planning you might be able to do. So as I said, why to check? It will actually give you whether the idea that you are working on is going to be the next big thing or not. It's as simple as that. So when you talk about this market size, it will tell you whether this is going to be a big thing or not. So this market size, in particular with the startups with startups related to technology area, is that people usually look for a trend or a wave. When a wave starts, the starting of the wave, if you do something, you go ahead with that wave and you create markets on your own. You create markets which were not existing before. So that is one important point of estimating markets, and that's going to be a little complex. So if you, the waves that we can talk about now, which happened in history, is one is the internet, the creation of internet and World Wide Web in the late 90s and the early 2000s. What happened is that we got internet and a lot of businesses started using internet. A lot of new businesses came up. So something called internet business started, and no one knew what was the market size. It was opening up. So when you did something on internet, you are riding on top of that wave. So that's what companies like, starting with Yahoo, Google, Facebook, Amazon did. So they started riding that wave, and that wave created a new market. So at the starting of the wave itself, people started forecasting how big the market would be, saying that in 2000 these many number of people are using internet, and in the next 5 years the number would rise like this. And when the number rises like this, when the market size increases, we will have X% of this market size, and we will automatically increase. So that's the way people pitch. So so the point I'm saying is that once you evaluate the market size, if you see that market is increasing its size, then you realize that you're on to something big. So that assessment you can do when you come up with the market size. Yeah. So again, when you have a what impresses the venture capitalist, what kind of market size impresses venture capitalist, and how the market size is important for the VC. So basically, the one big question these VCs have is that how do you exit? You tell him that this market is very huge. You have this fine, great idea which will create huge impact for its users. It will give huge value to its users, and you can make money. But how do you exit is a question that the investors usually have. Now, how do you do that? Typically, the exit is through acquisitions or IPO. Okay, so either by listing your company in a stock market or by getting acquired by a bigger company, that's when the exit happens. So to do this exit, what the investors need to understand is the market size. Only looking at the market size and the percentage share that you intend to achieve, an investor can say whether it is wise to put money at this stage so that he can exit in a handsome way at a later point of time. So these are the questions that typically users have. So what are the chances of getting the business successful? What are the chances of the business to raise next round of capital? Even that is important. So as you saw in the earlier slides, there are different phases for the company as per the growth. So in the initial phase, you have certain amount of capital, your own money, and then you start with your idea, and then you start getting customers, and then you scale up. So the different phases. So when a VC funds money in the Series A, he would invest money in a company for Series A only when he is confident that this company and this idea would be able to get further investments in Series B and Series C and so on. And finally, it will go to an IPO or an acquisition. So he will think about all these aspects, and when he thinks about these aspects, one important criteria is the market size. That's the reason it is very important for the investors. Now for the most important thing of how to calculate the market size for your idea. How do you do that? Okay, so there are three approaches that I have written down here, but these are not separate three activities. It is like to do market sizing, you will have to use all the three approaches and come up with the final size of the market. Okay, these are three separate thought processes. Using these three separate thought processes, you need to come up with your list of tasks and execute that and come up with the data and finalize the market size. That's what you have to do. So first, let's take the top down. We'll go take the example of Gillette shaving blades. Okay. So these three are top down, bottoms up, and bottom up, and public reports. These are three thought processes. Now, what are these top down? Top down is something that we have already discussed. It's simpler, but it gives a direction on how to approach it. So if you take Gillette razor, can you guys see it? Yeah. We'll take a Gillette razor. Now we want to analyze the market size of razors in India. So what are the assumptions? You need a lot of assumptions when you're doing the top-down approach. You cannot get all concrete data. So you need to, how do you make up the assumptions? You can get some certain amount of data from internet. The more complex the business idea is, that you need to use internet and you need to dig deeper for the data and come up with some assumptions. Those assumptions are men above 18 use razors, and another assumption you can put to fine tune this is that 80% of the same assumption, but we are just fine tuning it. About 80. Let's assume that other 20% goes beyond all the time. Whatever. So 80%, right? Now, what is the amount of total number of men in India? We can get it from internet. Total male population in India is almost we say 60 crore. Now total male above 80. This is around 60%. You have 60 crore, so we say 36 crore. Now another assumption that you make is that how many razors do a person use? Average one razor per year, at least 100 per razor. Okay, so this, so you say total addressable market. So that's a correct piece. We have 36 rupees 100. 36 crore people are there, and each person has the potential of buying a 100 rupee razor, and we are assuming he will buy it. We're not saying that we are never assuming here that they will buy Gillette razor or any brand, and we actually don't know whether in actuality, whether in reality this is actually happening. We don't know that. We are just making some assumptions so that we get some ballpark figures. So based on this, we get 3,600 crore rupees. Okay. So here, this is a top-down approach, wherein at a top level you make some assumptions, you get some numbers from internet, and you join these things together and say that okay, we have a market size of 3,600 crores. Okay. One more example we can take, a little more complex one. I'll do this example parallel to the Gillette example. That is for a breakfast delivery service which was done in a previous EVP course, breakfast delivery service. So how did we come up with the total addressable market size of breakfast delivery service in cities? Okay, this was the idea. Deliver breakfast in cities in India for working population. Where in houses where both husband and wife are working, people would want regular breakfast to be delivered at their home. So you using some app or web application, you place an order, or you give scheduled orders, and the breakfast will be delivered. As simple as that. So here, what they looked for is the total number of people, working couples in the top 8 cities. That's what they first came up with. Total number of working couples in top 8 Indian cities. So what they got was that before getting to that number, they assumed that 10% population of a city, 10% population of a city are customers of breakfast service. So they want to get the total number of working couples, right? So assume 10% of the population of the city are probable customers of breakfast service. Total population of 8 top cities. It came to around 6 crore. 6 crores. And then we get here, based on that you calculate this. So out of 6 crores, 60 lakh people are working couples, professionals who are having a yearly salary of more than 10 lakhs. That was the assumption. So we'll have 60 lakhs here. We have 60 lakhs over here. So 60 lakhs people are there who are eligible or who are probable customers of breakfast service. Then the next assumption was that how many times will they have breakfast through an online, not every day they might be going for breakfast by ordering, right? So we assumed 3 times a week and 50 weeks, so 150 times breakfast they will deliver through the app. Okay, 150 times breakfast. So and then another assumption was what is the minimum size of the order? Rupees 50 we had put as the minimum size of the order. Average, sorry, 75 was the average size. Average order price. Now what is the TAM? Total addressable market. We multiply everything. That is 60 lakhs. That is the number of people that we think who are eligible to buy this breakfast service. How did we get that number? We blindly said that okay, people who are getting a salary of more than 10 lakhs rupees, and we are taking it from the top 8 cities. So top 8 cities have got a population of 6 crores. So we said that 60 lakh people are eligible. They have the kind of money to buy. We are not saying that they are or they will buy. We are only saying that they have enough money to do it. And out of that, we say they will be ordering breakfast online 150 times a year. Half a year they'll be doing it. You won't be ordering breakfast every day online, right? So an assumption like that, 150, and then you're also saying that 75 rupees is the average order price. So once you multiply all these, what you'll be getting would be the total addressable market size of online breakfast delivery in Indian cities. Got it? So total addressable market size of breakfast delivery service in Indian cities. We never say that we will be able to target this whole thing, but we are saying when we start our own breakfast delivery service, what we'll be targeting is a percentage of this total addressable market. Okay. So this is the top-down approach, and as you might be understanding right now, this is not accurate. These numbers can go in both directions by a huge margin. These numbers are given only for you to start working on it and digging deeper. There's a top-down approach. So that's what we have seen is the top-down approach. Okay. So now what is the bottom-up approach? That's the next thing. That is going to be more tedious. And this will actually verify whatever data that we got in the top-down approach. So in the bottom-up approach, you have to do it the other way around. Here there are lesser assumptions. What you have to do is you have to do some surveys. You have to get out of the building and talk to people, talk to the real people outside, physical stores, etc. So first thing you need to understand here, say for example, you take the example of Gillette. How do Gillette sell their razors? In what all channels would the not just Gillette, through what all channels men buy razors? That's a question. That's the first thing that you need to understand. So we are talking about Gillette. We are coming up with the total addressable market size of men's razors. So the question here is that first thing is that what all are the different channels through which men buy this? So the channels might be small stores, the small stationery and grocery shops that you see in tier 2, tier 3 cities, the small ones. Or it can be the big stores, the large format stores, the big bazaar, more mega stores like that, huge format stores. Or it can be online. People might be buying these things through Amazon or Flipkart or all these online stores. Then other channels would be, there will be enterprise customers, the big chain of salon and spas, they will be buying in bulk and they'll be using it. The end customer might not be knowing what is the razor and all, but they too will be consuming. So you will have to first identify the channel through which the product or service is bought. So identify channels through which brought. So that's the first thing. Identify the channels. So there might be a number of channels. You identify that. Excuse me guys, let me plug in my charger. Yeah, sorry for that. So identify the channels through which the product or service is brought. That is the first thing. Now, in the case of Gillette, as we said, there are different channels through the customer can be buying razors. Now, we'll have to come up with some weightage, or you say how much of the sales will be through different channels. So we can say through large format retailers, this much percentage. I'm not talking about the actual numbers, but some percentage will be getting. You might be saying that online side, through online people do not buy much of razors, so only 20%, and 40% might be through large format stores, and another 40% might be through small stores. So you can have some distribution like that. And then the next important step is conduct surveys. That is, go to these people and talk to them. Conduct surveys with entities of different channels. So what do? To these small stores you can walk in. Okay, you can go to these small stores and ask them how many razors do they sell a day or in a week, and then you can extrapolate that data to understand how many razors they will be selling in a year. And once you talk to say 2 or 3 small shops, then you can extrapolate again that data to reach out to different associations and see how many such small shops are there in your city, and then multiply it by the number of city. Again, this might not be very concrete, but more than this top-down approach, this is actually you are going through the ground level and getting data and then extrapolating on that. So how do you get how many number of small shops are there? Maybe you might have to talk to some distributor in your city. When you talk to a distributor in your city, you will be getting to know how many small shops are there in different areas of the city. So when you add up these things, you might not be having the specific numbers. You might not be knowing whether it's 5,500 or 5,400. That's not the point. But you will know whether it's 5,000 or 10,000. That itself is a big thing, right? So once you get those numbers, you can extrapolate that for the entire population, the entire country. Think that these are the number of razors a small shop sells, and then these are the number of small shops that we have in a city like Bangalore or in Mumbai, and then you can extrapolate that, saying that you have these many cities where all the urban market activities are happening, say top 8 cities or top 10 cities, and then once you extrapolate that data, you will get a rough number of stores and how many razors they sell a year. You'll get that. Then you might want to talk to one of the large format retailers. It will be more difficult. It is easier to talk to a small retailer. It will be more difficult to talk to a large retailer. Somehow you can get this data maybe from their financial reports. And even the online channels, you might not be getting the data directly, but if you dig in through internet, you will get some data. So based on that, now you will be able to come up with the numbers saying that this is the number of razors being actually sold. In the earlier example, it was like you were going from the top. So from the top, you're saying this is the number of people. You're blindly assuming, you just have 120 crore people. That's the only thing you know. Out of that, you said, okay, half are men. Out of that 18 age, you said 36 crore, and directly you're multiplying, you're getting some number. But over here, you're going the other way around. From the ground level, you're doing some surveys, you are getting some data from the shop owners, from the retailers, and then you are adding this data and doing some sort of extrapolation, and based on those you get more concrete numbers. Okay, so once you do this activity, you will be getting more concrete numbers. So the point here being that for your idea, you need to do both these activities. You first need to come up with a top-down approach wherein you will draw the big picture on how your product is, which all areas would, which all kind of people would appeal to your product, and based on that you will have to come up. In the bottom-up approach, you doing it the other way around. You will get more granularity at this stage. At this stage, you will start thinking about different channels through which the customer might approach you. These are very innovative stuff. When you think about channels, that's when you brainstorm with your folks, you will get to know that there are different channels which your competitors might not have known about. Okay, so something innovative can be done over there, and through those channels you can create an entirely new market itself. Those things have happened. Okay, so when you think about a a completely new channel, a lot of things might open up and you will be tapping into different areas. So that is a bottom-up approach. And then the final thing is the public reports. There are a lot of companies which does a lot of reporting. Companies like uh, the big four accounting companies, the big four accounting firms. They run a lot of reports. Say for example, you want to, we were talking about the breakfast delivery. So you can look for reports about these big accounting firms like KPMG, uh, PwC, ENY. These are different big companies, big accounting firms, KPMG, uh, ENY, Ernst & Young, and PricewaterhouseCoopers, and there's one more firm I forgot. So there are big companies like this. Typically, accounting firms does a lot of surveys, and they have a lot of data with them, and based on that data they prepare reports. So if it is a breakfast delivery service, as we are talking, this KPMG would have, or one of these accounting firms would have done some reports for new age restaurants, report on restaurants, takeaways, internet, online restaurants. They would have done some reports saying that in the next 5 years, the Indian urban population is going to have this particular change, and because of these reasons, the current number of restaurants will increase to, say, this many times it will increase. And they might say that people spending 50 rupees now will start spending 200 rupees later. So all these reports will come. In those reports you'll find invaluable data. Those data, I'm not saying that you need to look for data which will, it's not like you need to look for data which will confirm your thesis. That's not the way it works. It is like, even when you have the idea at a very nascent stage, go through all these reports. If you have some idea on this breakfast service and all, try to go behind all the reports pertaining to food and beverages, F&B. If you have a breakthrough technology idea, say something related to Internet of Things, new stuff, then look into the reports of IoT given by these guys. So you'll find that there are a lot of stuff saying that in the next 5 years IoT is going to grow from, say, $100 million to $5 billion US. So you'll get a feeling, you'll get an understanding of how things are growing. So in those reports, they might even say that the 5 years from $100 million to $5 billion, the first 2 years are going to be difficult, and the next 3 years you will find more revenue coming in, you will find more customers signing up. So all these insights you will get. Those insights you will be getting from the public reports. So essentially what you have to do is that first you have to use the top-down approach to get a big picture. Then you need to do the bottom-up, wherein you go to the real people, do surveys, collect data. It is more painful job. You collect all this data and then apply some sort of big picture thinking and some insights that you got from the top-down thinking and extrapolate the data to make sure that using the top-down and bottom-up approach you have a more credible and concrete data. Then you also go to the public reports pertaining to your domain. So with these set of information, you should be able to come up with a comprehensive market size. Okay. So is that fine till now? Yeah. So now, since we have the market size, the next big thing is the unit economics. So have you guys invested in stock markets? Yeah. So if you have invested in stock markets, or if you have thought about investing in stock markets, how do you do it? Um, the correct way is that you find a lot of how do you assess these companies? You have a lot of companies over there. All these companies are listed. Now you would want to invest in a company which is promising. In the future it will make more money and where your investment is safe. So how do you evaluate that? You typically evaluate that by going through a lot of financial statements. I guess you would have already gone through your accounting 101 and basics of finance, wherein you might have understood the the balance statement, the income statement, P&L, the profit loss accounts, etc. So the cash flow statement. So these are different financial statements which are put onto the public domain by public listed companies. Going to the statements, you will be able to understand the financial health of the company. You will also be able to understand how the market is doing, how that industry is doing, and how good or bad the company is positioned within the industry between the competition. Okay, so you'll be getting all this information from this publicly available information. You'll be getting all this insight from the publicly available information. Now, how do you get this information about startups? How do you get it from startup? Or if you're an entrepreneur, how do you convey this information? There's no way to do that for a startup. For a startup, there's no point in coming up with all this complex financial stuff. You have to do it eventually as and when your company grows. But when your company is only an idea, or when your company is only about serving 100 or 200 customers, you don't have any credible data like that. And that's where you get unit economics. Okay. So what is unit economics? Unit economics is all about showing the profitability, or showing whether it's on profit or loss at a unit level. It is at a single. And what is the point of having it at a unit level? When you can determine something is profitable or non-profitable at a unit level, you can again replicate that to a huge number. That is, you can show scale and say that for this unit, if I am making this particular small profit, when I scale, I can make this much amount of profit. Plus, on scaling, you can show efficiency and you can improve the margin while going from 1 to say 10,000. We'll understand that. I'll take a simple example of usually there are other examples, but my favorite example is that of a biryani. Let me just take that. Okay. So we did this as part of that breakfast service. Obviously, you don't eat biryani for a breakfast, but we started with biryani and then we went behind other actual food items, and then we could build the proper unit economics for breakfast delivery. So if you talk about a biryani, we put the price of biryani as rupees 180. This is the typical average price of biryani in any Indian city. Okay. Now, to make biryani, what are the things you need? Okay, you need raw food items. Okay, what are rice, ghee, vegetables, meat, etc. Okay, that is the all raw food items. And then, what are the other expenses that you incur? You will incur salary expense of your chef, cook, whatever, of chef, cook, helpers. Say if you are doing through home delivery or biryani on call, then you have some call center guys, call center execs. Okay. Now what else? You'll have kitchen expense. I mean, we have accounted for the raw materials, whatever rice and everything you have to buy, but there is a kitchen expense, setting up the kitchen, right? The initial setup cost for kitchen. Initial setup cost for kitchen. We have that. Then you have running cost for kitchen. So what would be this one? This will be electricity. Then cleaning, rent. So the initial setup, you will have utensils, you will have rent, mats, etc. There will be a lot of things. I don't want to put everything. Here also there will be a lot of running cost. Okay. What else? Anything else? So if you have a delivery, your business is on biryani delivery. So let's assume delivery cost. Okay. So all these will be there. Now, how do you come up with this? Now, for the raw materials, now you don't make one biryani, right? You make a certain number of biryani. So we have to make some assumptions and say that you are targeting to make 100 biryanis a day, and you have a slot of 100. Every 100 biryani, okay, you can add it. So you have to finalize one group over there. So we went with 100 biryanis. So for 100 biryanis, how much meat and how much rice and all this thing you need. And then you divide that total by 100, then you will get the rice and all this stuff, raw material required for one biryani. So we came up with something like rupees 40. That was we came. Okay, rupees 40 is required for one biryani. Now, now let me take this delivery cost down, because that is more easier. So again, delivery cost, we have rupees 30, because you're delivering to a neighboring area, some 4 kilometers. So you already put some cost, you got some bikes and some folks to deliver the food. So you have done some R&D on that, and you know that 30 rupees is the delivery cost per biryani. So maybe you are engineering for 100 biryani delivery, and out of that you found that based on these people, delivery boys, you found around 30 rupees per delivery is a cost involved. Now the further things, these are going to be more tricky. Now the problem here is that these are not incremental, salary expense of chef. For a month, if you make 1,000 biryani or 10,000 biryani, it's almost the same. You will have one chef who will design that kind of biryani that you need, and you will have some 2 or 3 cooks and some helpers. So once you sign up them, you need to pay them salary, irrespective of whether you sell biryani, you make biryani, you need to, pay them salaries, right? So you have to, what you have to do is that you have to first say that, okay, in this particular first month, I am trying to sell this many biryanis. For that, I would require these many number of chef, cook, helpers, call center executives, and then put a cost for them. Say something, chef would take 15K for a month, cooks would take 7K, something like that. You'll get some 1 lakh rupees per month. And then you divide it by the target that you have. Say 10,000 biryanis will be selling a month, the first month. So you'll be getting something like 10 rupees or 20 rupees. So let's just put, for the sake of it, as 20. Okay, so you'll have the salary expense as 20 rupees, and again initial expense also, let's assume it as 20. This also you have to put effort and understand what will be the utensils that you'll be putting. Maybe it makes sense to buy utensils which are bigger and set up everything in a large scale, so that you can sustain that for the next full 1 year. Got it, right? So you can sustain all those things for 1 year. So initially maybe your expenses are higher. Why? Because of that you might have invested, say 10 lakhs rupees on this rendered vans and utensils, etc. And this 10 lakhs you invested so that you have the capacity of making, say 1,000 biryanis a day. But in the initial months you will only be making 100 biryanis a day. So in the initial months your unit cost, this particular entry in the unit cost might be higher, but with scale you might be able to bring it down. That is the point. And running cost of kitchen, again that electricity, cleaning, all those things will come, you will put some amount here. So this is how unit cost would look like. So now to give it more detail, I can show you the unit cost calculation of this breakfast delivery service. So in the breakfast delivery service, we first came up with the menu. In the menu, we said what is the COGS? COGS is the cost of goods sold. Okay, that is the raw material I was talking over here. raw food items, saying 40 rupees, right, for a 180 rupee biryani. So like that, for each one we have a MRP and we had the COGS. Okay, you have to prepare that. This MRP, how did we prepare? We came up with this MRP by looking at how our competitors are selling. You can always look at competitors. Okay. So for a breakfast delivery service, we checked other restaurants which are selling breakfast, and we got this list of MRP. We got this price list. We did some averaging. That is, there are high-end breakfast services, there are low-end breakfast services. We went through a bit of data mining over here. We got these numbers, and then we started looking at, like, for chapati kurma, how much COGS is required, how much wheat, how much vegetables are required. It does not include the salary of the cook and all. Those things are outside. So we just noting down the COGS over here. That will be the first entry for your unit price, unit economics. Sorry. So you got that. Like this, you will prepare everything. Then in the kitchen setup and operational cost, we will talk about the delivery staff, how many would be the cleaners, landline cost, electricity and water. All these things would be added up, and we'll also say how many breakfast we will be selling a month in the first phase. So based on that, based on these assumptions here, phase 1 average order per day is 50, average price of the order is rupees 100, and average cost of prepared food is 30. So based on this, we come up with the COGS. So that will be the first entry. So here in unit economics, we said COGS is 30. Okay. Then we also had on this package cost and delivery cost, salary cost. And the salary cost was calculated, that 32 was calculated by this kitchen setup cost. So this whole thing was added for the salary cost. So if you look at here, this is the point I'm explaining. The COGS would remain almost the same in all the phases, because you have to put more ingredients to make more food. That's it. It's as simple as that. So the COGS remains same. But if you look at this salary cost, the salary cost has gone down. So phase 1, we were planning to sell around, say, 1,000 units of breakfast services. In phase 2, it became like 10,000. But the salary is not increasing. We won't be increasing the number of cooks and chefs that much, right? When you have 1,000 units, you have one cook and two cooks and some helpers. When you go from 1,000 units, 10,000 units, maybe you will double or triple those numbers. By this time, you yourself know how to improve the productivity and how to improve the efficiency of the system. So because of those reasons, your salary cost should come down. Okay, and that will take that will improve your margins. You need to make some profit, right? So in the unit economics, what you have to prove is that with scale you are able to improve your margin. If you look at the unit economics of companies like Flipkart, you'll see that the margin is still negative. That's a problem that they're facing. But how did they get all this funding? That will be a very interesting question, right? Even with the negative margin, they are able to get funding. They got the funding because they were able to project to the investors that in due course they will be able to get back the money. They will be able to put efficiency into the system, and by bringing in efficiency, there will be a lot of fixed costs. I mean, there will be a lot of costs which are fixed, which will be lessened with scale. When you have 1,000 customers, you have a fixed cost. But when you go from 1,000 to million customers, the fixed cost would not increase in that fold. It will only marginally increase. It might become 2x. That's it. So just imagine, when you had 1,000 users, you had fixed cost of X. When you go from 1,000 users to a million users, your fixed cost is going from X to, say, 2x. So that will have a huge benefit on your margins. Your margins will increase like anything. So that is the enticing factor that you need to add. You don't need to purposefully add that. That should come out from your unit cost, unit economics. Okay. So So to reiterate the whole point, building the unit economics is all about coming up with the different constituents for a unit being sold by you. If it is a breakfast service for one delivery, what is the unit price that you have? And for that, well, for selling that unit, what is the cost of goods sold that you have? What are the other incremental costs that you have? Plus, what are the fixed costs that you have? You need to list all this down. And for listing these things down, you need to work backwards, wherein you have to say how much would be your salary cost, how much you would be investing in your fixed assets, like buying up utensils, buying up machinery, or if it is a company like Flipkart, if it's a technology company, how much developers would you be hiring, how much money would you be spending on the software solution, because that will be huge. So if you put the same example for a company like Flipkart, the salary cost will be huge for them. Salary cost will be very huge. They have huge salary cost for being paid to all these developers. And when do they make money? They won't make money when they have a million users. They will make money when they get some 100 million, 200 million users. When they capture the entire Indian market, that's when they make money. Because they won't increase the number of engineers, right? Engineers write code once and that is deployed. So that's how you have to calculate the unit economics. So here we have given some examples like for service business like Infosys, and for e-commerce we have put some simple examples. For a company like Infi or Wipro, what is the unit? In what business are they working? They are selling time of people, right? Time of engineers. So basically, they're saying that to do this job, you require 100 engineers working for say 100 days. So they calculate hours. They say that 10,000 hours is required, and per hour this is the charge. $50 is the charge. So their unit is engineer per hour. So they say that how do they come up with the unit economics? They say that this is the amount being paid to an engineer per hour. This is the total cost of the engineer per hour, and this is the money that the engineer brings in per hour. So doing all this calculation, they'll be able to project. This is our unit economics. Similarly, the case of e-commerce, the unit is one customer. So here there is one more point to be noted down. When you go for B2C business, you have a concept of customer acquisition cost. To acquire a customer, what is the effort or capital that is required? To acquire a customer, how much money you spend? There is a customer acquisition cost. Then there is something called a CLTV, customer lifetime value. So these things is evident in B2C business and SaaS-based businesses, because you don't get the customer for the entire lifetime. There is a time period that you have to specify. In typical SaaS business or B2C business, we say 3 years. You get a customer for 3 years, okay? And so you assume that the customer that you get will pay you money for the next 3 years. So in a sense, your CLTV, that is your customer lifetime value, the money that the customer brings in, minus the customer acquisition cost, would tell you whether you are profitable. That will essentially tell you that whether unit economics is working or not. Essentially what it means is that if you spend more time in acquiring customer, more money in acquiring customer, and then customer returns you lesser money, what it means is you are in loss. But if you put X rupees in getting the customer, and this customer gives you some profit of 3x in a period of 3 years, what it means is that there is a difference of 2x, which means you will be able to make profit. Okay. Yeah. So that's how unit economics works. And if unit economics are favorable, then investors don't look at other costs, particularly the salary cost. Even if you have huge salary cost, but if you show a unit economics where you have some profit, even if it is small, it's fine. Because what it shows is that with scale, you can bring all other fixed costs like salary, and then you can make a killing. You can make a lot of money. The final thing is go-to-market, GTM. So over here, what we have to come up with is the GTM strategy. That is how to approach the market. So how to approach the market. So what we have covered till now is the we have checked whether there is a pain or not, whether there is a customer. So that is a market sizing, right? Whether there is a pain or not, we checked by looking at the market sizing. We evaluated that whether this is a valid pain, whether this solution when once built, would there be people to buy this solution? We evaluated that by market sizing. That was also evident with whether the question that whether the need is painful enough, whether people will pay money for it. Large number of people with the need, you created a solution to the need, and you got that idea from unit economics also. So essentially in market sizing and unit economics, what you have confirmed is that this particular idea that we are talking about, that your pet idea that you're saying is a next $1 billion idea, is it really a $1 billion idea? Would people buy it? Is there a real pain which can be resolved by this idea or service or product? Would people buy it? And is it feasible? Is it viable? That's the right word. Is solving this idea viable? You get that answer from the unit economics. There are some ideas where people are willing to pay money, but the cost of solving that idea is so huge. Maybe sending someone to the moon. People want to go to the moon, right? It's fun, but it's so huge. It's very expensive. Would people be, if you ask anyone on the street, do you want to travel in space? They would say, yeah, I would like to travel in space. Would they be ready to shell out, say, $1 million to travel in space? No, they won't. So it's not viable, right? So that's what comes in the unit economics. In unit economics, you will work through the idea, you'll work different aspects of implementing the idea. You will understand what are the incremental cost, you will understand what are the fixed cost, and then you'll be able to figure out a mechanism in which you can say that this will be the cost at a unit level for producing one biryani. This is the cost, this is the electricity cost, this is the water charges, this is the salary cost. And when I go from 1 to 1000 and 1000 to million and million to 100 million, this is the way it will scale, and this is the way I bring efficiency, and I'll be able to bring down these fixed costs, and my margin will go up. So all these things came with the unit economics. Now, the next thing is, the final thing is the GTM, the go-to-market strategy. How exactly will you get the customers? That is a GTM. Now, for that, the first thing is that the channels. In which all channels will you be able to get customers? Okay. Is it the online acquisition? Do you sell through online, or you send out people? You conduct road shows. One example with this breakfast delivery service is that the first channel that we sought was field sales. We planned for road shows. We set up stalls in different apartment complexes in certain areas. In one particular area that we selected in Bangalore, and over there we set up a road show where we gave free breakfast for the residents to try it out. So we did all these things, and from that initial channel we got initial set of data of customers. With this data we started building other channels. So you need to understand which are the channels that you will be selling your product or service. It depends on your product or service. Certain products or service can only be sold through online channels. Certain things are there which are viral, like WhatsApp. The more people you log into the network, the more powerful the network becomes. There's something called the network effect over there. The more people you sign up, the more strengthened the network is. It will become very cheaper to get the next person. So you have 1 million people in the network, it's very easy to get the 1 million person. Okay, so that is virality. So it depends on your product and service, what sort of GTM strategy that you would adopt. So these are the different strategies. These are not the only ones. The major ones that we see now is online acquisitions and virality. And field sales, as I talked about, you send out people on the field and get the sale done. And channel is one more GTM strategy. That is, there will be existing people who are doing businesses. Say, say for example, you are launching a new mobile phone. Okay, so there will be existing channels. There will be people who are already selling mobiles, big distributors, resellers. Called one big reseller or distributor I know is Reddington. That's a big company which is a reseller of Apple phones. So Apple does not sell phones in India. They sell phones to a company called Reddington. And this Reddington, the company called Reddington, actually sells Apple phones in India. So Apple does not have a sales channel, sales force in India. They tied up with a company called Reddington, and Reddington is selling the Apple phones. So that's a partnership. So you can enter into partnerships and sell it. So those are different strategies that you have to think through. Okay. So to wrap it up, these are the three aspects that you need to think about. One is the market sizing, which is more, I wouldn't say simple, but it's more about collecting the data. In market sizing, you've got top-down approach, then bottom-up approach, and the collecting the public reports. In all these three things, what you essentially do is that you go through, you come up with the big picture first, and then the top-down approach, and then drill down with the numbers. And the bottom-up approach, you actually talk to people, do surveys, and extrapolate that data, and bring in all this public report to add meat to your data. That's when you come with the market sizing. You tell that this is the total addressable market. It is not what you intend to achieve. It is a total addressable market. It's a complete market that you have. Then you come up with the unit economics, where you say that what would be the cost involved in serving one unit of product or service, and there are intricacies like customer lifetime value, customer acquisition cost in B2C especially, and based on that you'll have to say whether it's profitable or in loss, and over a period of time how you will improve your margins. If it is a negative, how do you go to positive, or if it is a small positive number, how do you improve these margins over a period of time. Then finally you have the go-to-market strategy, where you have to say how exactly you will acquire the customer. Whether it's an online acquisition, through online would you be acquiring customer, or is it offline modes like field sales where you have your own sales force, or is it through different channels, partnerships, or is it virally like Facebook or WhatsApp. Okay. So these are the concepts. Hope you guys understood it. As I told, these are little complex and little heavy. So maybe you'll have to go through this presentation more than once, stop here and there, and do some googling on your own on these unit economics and market sizing. I think this market sizing and unit economics are a little more complex. You might have to put some effort from your side, doing some googling, trying to go through some of the material, and don't spend too much time. The moment you get a grasp on these things, work on your idea and come up with the unit economics and market sizing. Let's meet in the next session. So hopefully in the next session, by the next session, what I would see is that we would be having an initial draft. When I say initial draft, you would have come up with the market sizing, and then the unit economics and the go-to-market strategy. These three areas would be covering by the next session, and you would have submitted your rough draft. I think the rough draft submission has to be done by this coming Wednesday or Thursday. Please confirm that with Ashish. So you would have to submit your rough draft. So what I expect from the rough draft is, for your idea, what is the market size that you expect, how you are arriving at that market size. It is not just the number, say 100 crores. We need to know how this 100 crores has been achieved. And then your unit economics. You need to exactly say how much money would be spent on what. What is the costs, what is the salary cost, what are the other fixed costs other than salary. You need to come up with all this data. And then finally your go-to-market strategy, how exactly you're going to acquire your customers. put everything, all these things together. Let's brainstorm. Let's meet in the next session and go through each and every submission. I think there are some 4 or 5 groups. Let's take time, go through the submission of each group. So in the next session, we won't be having any PPT or anything like this. All of you would have to mandatorily be to attend the session wherein we'll go through these submissions and evaluate what went right, what went wrong. Okay, that is about the Wednesday submission. Now coming to the pitch, there is a 2-minute elevator pitch video which you guys have to upload. About elevator pitch, have you guys heard about elevator pitch? No? Okay, so it's like this. For all these investors or any, when you're pitching an idea, you typically pitch idea to investors, stakeholders, or maybe even to your CEO, your director, some top guy in your company. You pitch to these guys, right? Typically, these guys will be very busy and they won't give you an appointment. So what do? So the saying is that you get on to the elevator with them. When they are walking past you and they don't have time to give you to listen to you, they just say that, okay, come with me to the elevator, the lift. Okay, and when the lift is moving, during those 30 seconds or 1 minute, you talk about your idea. That's it. It's just a small time period. It's a small time interval you get, and your CEO or the investor says that, okay, shoot, tell me what is your idea. What is your great idea? Tell me. And you just have 30 seconds or one minute, and you have to talk about that. So in that elevator pitch, you have to entice, you have to convince this guy that this is going to be the next big thing, and you don't have to go through the each and every details and numbers. The aim of the elevator pitch is to get an appointment where you make the real pitch. That is the aim of the elevator pitch. So it should be very much enticing. It should not go into too much detail. You can Google about this elevator pitch also. There will be nice elevator pitches uploaded in YouTube. Go through that. So what you have to do is that it's not 30 seconds or 1 minute. Make an elevator pitch for 2 minutes. Okay, that will be more better for you guys, for your idea. And this submission has to be done at an individual level. So each of you, for the idea that you guys have decided for your group, say if you are a group of 5 people and you have decided on one idea, each of you go back and work on your idea and write a script for yourself and then record that elevator pitch for 2 minutes. Record that on a video and then upload in YouTube and send across the URL. That's what you have to do. Okay. So 2 things. One thing that you have to immediately do is create the elevator pitch video. Second thing is that you need to give the submission on the rough draft, where you will detail the unit economics, market sizing, and go-to-market strategy. Okay. So I guess you enjoyed this session. Please reach out to me through mail or through mobile. You guys can call me any day after say 7 o'clock. You can call me or you can send me an email. I'll be happy to reply to your emails, or you can WhatsApp me this number. Okay. Thank you guys.